Good evening and welcome to another episode of the Weekly Market Wrap. My name is Daniel Ang. Today, of course, is December 14. We are 11 days away from Christmas. And although we were expecting some fireworks to happen this past week because of the FOMC, however, the market was pretty calm. We saw mixed reaction in US equity markets. We saw that the most unlikely sector of the market, the small cap actually was doing very, very well this past week. We knew that the Russell 2000 actually went into new high. So is the Dow Jones. So the Dow Jones and the Russell 2000 actually created new highs, whereas the S&P 500 and the NASDAQ 100 did not. In fact, they both fell, with the NASDAQ 100 taking the blunt of it, going down by 1.9%. So we'll be talking a little bit about the FOMC meeting and the impact that it had. And before we go into the content itself, let me remind you that this is a presentation in which I am not trying to encourage you to buy or sell any kind of securities, be it futures, options, CFDs, FX, or even cryptocurrencies. Now, the trading of any kind of margin financial products do carry the element of risk, so be aware of your own risk tolerance before you attempt to trade any kind of margin products. And I will be sharing with you my views on the various market as we go along, and I will not be responsible for any action that you may take as a result of attending this presentation. And of course, the content of this presentation has not been reviewed by any regulatory body, including those in Singapore. So if you're okay with that, let's get started. Now, the first thing that came in fact, was the only event, which is the FOMC meeting in the early morning hours of Thursday, December the 10th. The market did not surprise. The market was actually pricing in a 25 basis point cut, in which this is what we are seeing. The market actually came in, or rather the Federal Reserve actually cut interest rates by 0.25%. Now the effective Fed fund rate is floating anywhere between 3.5 to 3.75%, with expectation that more will be coming in 2026. Now the next FOMC meeting is scheduled for the end of January. So not sure whether that will be the month in which the Federal Reserve will continue to cut. Now this is the third cut this year, after pausing the rate for a year at 4.5%. So we can see the market do expect the Federal Reserve to continue to cut. And the other thing that we have to consider is that the chairman, Jeremy Powell, his term is going to end in May of 2026. So President Trump has already said that he has more or less decided who he wants to nominate as the next Fed chairman. Okay, there were a few candidates, but I think the odds has just shifted. Okay, there was this front runner called Kevin Hassett, and the other one is of course Kevin, I believe, of Kevin Wash or something like that. Okay, so I think between the two of them, it looks like Kevin Hassett now has dropped into second place in terms of market expectation that he will take over the chairmanship. But regardless who will be the next chairman of the Federal Reserve, the President Trump actually fully expect the person who is going to be taking over the chairmanship to actually be more in line with the White House in terms of getting interest rate drastically lower. Now, Trump has previously mentioned that he wants interest rate to be at 1%. So whoever who is going to be running the Federal Reserve may have no choice but to cut interest rate at the expense of a runaway inflation. I think the Federal Reserve is very clear that if they allow interest rate to continue to be cut, okay, between economic growth and inflation, I think they are prepared to sacrifice inflation. Meaning to say that if the Federal Reserve cut interest rate going forward, it will be highly inflationary. But I think at the moment itself, we all knew why the reason the White House wants to cut interest rate pronto, because trillions of debts need to be rolled over, okay? And they don't want to be rolling over at high interest rates. For the time being, we knew that the Treasury Secretary, Scott Bessent, has been rolling over using the shorter term bills, okay, the 30 days and the 90 days, okay. So this is problematic because every 30 days or 90 days, they have to go back into the market to actually issue new treasury bills to roll over. So they are doing this as a stock gauge measure for the short term. They are prepared to bite the bullet to roll over their commitment, okay, by issuing more and more shorter term treasury bills until the time where interest rate comes down so that they can roll over the long bonds, which is the 20 years and 30-year bonds. At this current rate, it is almost impossible to refinance at this current rate. Okay, so this is the thinking of the White House. They need to get the interest rate down because we already know that the interest payment on servicing the $38.2 trillion of debt is more than $1.2 trillion and growing. Okay, so they need to refinance at much lower rate than what the current market is quoting right now. So there will come a point in time, uh, whatever the Federal Reserve do. Now you have to understand that the Fed fund rates, okay, has no impact on mortgages, car loans, credit cards, because the Federal Reserve can only influence the interbank rate, which is the overnight rates, okay, which the commercial banks need to borrow. Okay, those will not impact the those loans that matters, mortgage loans, car loans, student loans, credit card loans, those will not be impacted. In fact, there is the likelihood we may see higher mortgage rates going forward. Okay, so this is something that we have to consider. But I think at the moment in time, what they want to do is basically get interest rate down so that they can refinance their outsized their national debt at much lower interest rates. So that would be the main thing. Okay, so inflation, I don't think they care anymore. Okay, if that is going to be the price they have to pay to get interest rate down, they are prepared to face runaway inflation. Okay, so going forward, we knew that in a highly inflationary environment, how are you going to rebalance your portfolio and what are the instruments you should be looking to benefit from such a move? Okay, so this will be the same thing that we'll be talking about month after month going into 2026. Now, next week is going to be different. Next week, we're going to be hearing from the Bank of Japan, which is on a divergent path relative to the Federal Reserve. The Bank of Japan wants to hike interest rates. Currently, it's 0.5%. There are talks that they will move it up to 0.75% and perhaps hitting 1% early next year. Okay, so while the Federal Reserve is hoping to cut rates, the Bank of Japan is looking to hike interest rates because inflation is really high in Japan right now. But it is actually not the solution because we knew the Q3 GDP numbers has been revised drastically lower for Japan. So we know that the Japanese economy is shrinking faster than the market expectation. So to hike interest rates in the face of a slowing down economy, it is almost suicidal. Okay, but I think they have no choice. On the other hand, we have the administration, which is the governments led by this Sanai Kaiichi, wants to stimulate the economy. The Bank of Japan has already mentioned many times that they are in no mood to buy whatever bonds that will be floated because they have to the eyeball in terms of JGBs. Okay, in fact, they are hoping to actually exit the Japanese stock market over a period of 100 years, gradually to disengage because the Bank of Japan right now is the largest holder of Japanese equity through the various ETF. And of course, we also have to consider the impact by pension funds and insurance companies. They are all up to the eyeballs and they are in no mood to buy more JGBs. So this will have catastrophic repercussion. There could be a case in which if the Japanese yen continue to weaken, okay, or if they have to raise the money to stimulate the economy, meaning to say Japan needs to raise a lot of money because we are talking about more than $120 billion worth of stimulus. So where do Japan find the money to do the stimulus package? One way is for them to sell their holdings of American treasuries, okay? And if that's the case, it will cost Treasury to actually go down even further than what it is currently doing. At the same time, it will spike US Treasury yield. So this is actually not what the United States want to see, because they want the yield to come down. But if Japan started to stimulate the economy, and if they do so via selling of US treasuries, it will cause yield to spike in the United States. So it will basically cancel out whatever interest rate cut that the Federal Reserve may be doing going forward. So we are in a dicey position. And of course, that will also mean that it's a risk that the yen carry trade might unwind. Okay. Higher interest rates means those fund managers who have previously been borrowing in Japanese yen term, paying next to nothing interest rates, now have to consider whether it is still worth their while to consider to continue to hold the Japanese loans. They may be motivated to actually retire those loans. And if they do that, it means they will have to sell assets somewhere else, raise the money, convert into Japanese yen, and return back the loan. This will have repercussions not only in currency markets, it will have an impact on all markets. So going forward, next week, between 19 on we're going to have a 2 days meeting on 18 and 19. Okay, just 1 week before the Christmas holidays, and this could be the last straw that breaks the camel's back, so to say. Okay, so next week could be more volatile than what we are seeing this week. And of course, there are other key economic data that will be released next week. Okay, we'll go forward. Now, in the meantime, we knew that the Federal Reserve has already announced, okay, that they are going to stop quantitative tightening. Now, that is already priced in. In fact, that stopped on the first day of December. And this week, we also hear that the Federal Reserve will turn on the pump again. Now, this is not quantitative easing per se, because they have coined a new term called the reserve management purchases. They call it technical buying, but what they are trying to do is they want to inject liquidity into the marketplace to the tune of $40 billion per month. Okay, starting the 1st of January. First, of course, it's a New Year's Day. So what we do know is that come January next month, the Federal Reserve is planning to inject more liquidity into the marketplace. So this will make sure that there will be a lot more liquidity, because the market right now is pretty tight. Because year end, there's going to be a lot of window dressing. The banks need to shore up their reserve, and now there are even talks that the U.S. Treasury and maybe even the Federal Reserve may actually loosen the reserve requirement for banks, because the market is not having enough liquidity to continue to shore up their reserve. So this is injecting liquidity into the marketplace. It will be welcomed by players and investors, because that will be seen to be stimulating the stock market. It will be crazy to do that, because the United States are right now cutting interest rates when Wall Street is at record high. So we have a booming stock market, and if they cut interest rate, that will ignite a runaway inflation. Okay, at this moment in time, they should be raising interest rate, but they are not. Okay, so they are injecting more liquidity, basically putting more fuel to the fire. So all these are all happening at the same time between United States and Japan. So they are both going in a divergent path. So expect volatility to spike into the coming week. Okay. Now, the other news that came in was all this talk about AI now has come to a head. Oracle has saw its share price down by 40% from the peak. Okay. Oracle, as we all know, is one of those tech companies that house they actually provide the support for a lot of AI companies. Okay. So now it seems that Oracle shares have missed their estimates, and investors are jumping ship. We have seen, although there was a bit of a rebound, but we can see from this chart over here that Oracle is far away from its all-time high. In fact, it has already fallen 40% from its peak. Now, this is one news that has actually stroked fear that the tech rally may be compromised. Okay, we all knew that the tech fever is premised on the fact that AI is going to be the real way, the real road. Okay, going back into the 30s. Okay, so the equivalent of AI now is seen to be what sparked the Industrial Revolution in England years ago, okay, 100 years ago. So now we are seeing that results from tech companies are not ideal. Oracle shares are falling and it continues to fall. And then we have not only one punch, we have a 1-2 combination punch because Broadcom, another AI company that makes chips, okay, is also reporting that they are earning missed estimates. In a pre-market opening on Friday, the market fell by 5%. So we knew that all this is adding to the anxiety by investors. That is the reason why the Nasdaq 100, instead of rising with the Dow Jones and the Russell 2000 on Friday, actually closed down 1.9%. So there is a little bit of unwinding in tech stocks. Not sure whether that will be the one that will cause an avalanche. Okay, well, we will continue to monitor because the fear of this AI bubble is getting very real for many investors. Okay, so as we go into the year end, investors will be looking to square their books, especially asset managers. They want to square their books. So if they got profit in tech stocks, maybe they want to book them, and that means they will have to sell. Okay, so that could be the motivation in behind the tech stocks decline this past week. Now, going into the new week is going to be very packed in terms of the calendar. On Tuesday, we have the non-farm payroll. This is actually for this is the number that remember we don't have the number for October. So here you can see previous there was no number, okay? So we are basically thinking that it will be at 35,000 jobs. Meaning to say that the estimate is that for the US to create 35,000 jobs. Now even if that is true, it will still be on the lower end of the scale. Unemployment rate is expected to stay at 4.4%, which is the highest we have ever seen since the COVID lockdown. Okay. Now, average hour earnings, we have no idea because October there was no release. So November, not only we do not know what to expect, we also have no idea what October did. So it will be very interesting, so to say. Okay. So going into the non-farm payroll, it will be volatile. Now, the other number that will also impact markets is the retail sales number. Now, this is a backward-looking number because this is for October. For the month-over-month, October retail sales is expected to stay constant at 0.2%. Okay, it may be worse, but I think market just trying to play safe by expecting the last known number, 0.2% on a month-over-month basis for retail sales. So if retail sales coming weaker than expected, we can expect the market to react negatively. Okay, and that may also prompt the Federal Reserve to actually get ready to cut in January. Okay, now the control group expected to rebound from negative 0.1 to positive 0.3. Not sure why they are so confident. It could be the holiday season's sales that could be impacting that. Okay, we have Thanksgiving, we have now going into a Christmas holiday followed by New Year, so there could be a little bit of holiday shopping going on. Okay, so if that's the case, it's going to be one-off. Once the holidays are over, come January or February, the numbers should come back to earth. Now, the other numbers that we will be expecting on Tuesday is the PMI numbers, the Purchasing Managers Index for the month of December. So this is current, okay, because this is collated and going to be released by a private enterprise, not the US government. So no expectation. The previous number for December in terms of Manufacturing Purchasing Managers Index was at 52.2. Okay, so no expectation here. Services, PMI, previously was 54.1. Again, no expectation. So again, there are a lot of missing consensus here. Yeah, somebody please turn off
Is
your.
there slide? There is no slide.
There is no slide.
Yeah.
Oh, you guys should alert me earlier than now. Let me see where is the slide. You got to tell me earlier. You cannot see the slide. You got to tell me. I have gone through so many slides before you tell me. Okay, anyway, let me take a look. What is the issue here? Hmm. All right. You should be able to see, but anyway, I will share it one more time. Can you see my slide now? Can you see my slide now? Yes. All right, I'm not getting feedback. Okay, good. Thank you very much. Now you're able to see my slide. Okay, the next time, if I'm not aware that you're not seeing my slide, please turn on the speaker and alert me because I'm not looking at the chat. Okay, anyway, I was saying that the coming week is going to be quite volatile because we're going to be expecting a lot of data to be released, and key among them will be sorry, what am I doing? Key among them will be also the CPI numbers. So we have non-farm payroll, we have retail sales. These are high impact news followed by the CPI. Okay, so this CPI will be the latest. This is for November. Again, no estimates on a month-over-month basis for the month of November. The October numbers again, was 0.3. The core is at 0.2, no expectation. However, the year-over-year number expected to ease up a little bit. The year-over-year number for the headline CPI numbers is expected to be at 3.2% relative to 3% previously. And the core, meaning to say you remove the food and energy component of the CPI, they also expect it to bump up to 3.2% relative to 3%. Then, of course, the biggest event to expect next week is the Bank of Japan interest rate decision. Okay, market has already priced in a 25 basis point hike. So unless it come out very different, then of course we'll be looking at a different outcome. Okay, so I'm done with the expected data set. Let's move on to the. Let me see how my. Let's move on to the my trading platform. Hopefully you can see my trading platform chart right now. I will start off with the Dow Jones. So again, if you have any question, do pop them into the chat box. Okay, thank you very much. Now, the Dow Jones, like I said earlier on, managed to register a new high for the series. We can see that this is the Dow Jones. This is a brand new high this past week, is at 48,884.4. Okay, so this is a brand new high. Does it pays to chase? That is the million-dollar question. There is no sign that the market is getting ready to pull back just yet. So it may actually continue to go up on its current momentum, but I'm always a little bit leery because the biggest and the most successful investors in history is not getting into the market. I'm talking about Warren Buffett. Okay, he is holding hundreds of billions of dollars in cash. Well, technically not in cash, he's holding them in US treasuries. Okay, but he is not committing to the markets at this moment in time. And that can only mean that he expect, okay, the market to correct. We're not expecting a crash, but if Warren Buffett is not getting into position, that means he do expect the exact opposite to happen. It is a well-known fact that he also considered the valuation of companies listed on Wall Street is getting too rich. So that is his belief, and the man has never been wrong. So it's a matter of timing. So if I'm going to be in that position whether to decide to buy right now, since market are at all-time high, I may decide to sit it out. After all, we are going into the holiday seasons. There could be some window dressing towards the end of the year. And once that buying is over, I think the answer will come in January. Okay, so perhaps it's the best to book some profit and then go for holidays if you are in equity markets. So this is the weekly time frame for the Dow Jones. Dow Jones, based on this series of upward bias, has a target projected at 53,600. Okay, that will be the logical target for me. Whether or not you can get there is another story. Okay, but it does have the potential. And because price has already left the parameter, in my opinion, this is not a good level to go in and buy right now. If there is a pullback, maybe so. But now the market is at all-time high. It will be quite challenging to commit to buying at a high. Okay, so this is the daily time frame. Again, there is nothing to suggest that the market is about to end this bull market. Okay, immediate target in the daily time frame is at 49,300 thereabout. Okay, so it is not that far away from Friday's high. Okay, so based on momentum, it does look like it may have some fuel left in terms of challenging the all-time high. Okay, there could be new highs along the way for all we know. Okay, so let me see if I can call up an indicator called the ADX. Now, the ADX is not trending in the way I would expect this market, because the price action suggests that this market is trending very, very strongly. But the ADX is not telling me the same story. I need to see the index climb like this to tell me that there is momentum behind this rally here. Right now, it is, yeah, there is a little bit of momentum, but it is not in the uh, uh, manner that I would like to see. Okay, so if you ask me whether I'm going to be involved in the markets, I'm probably not. Okay, not even buying, not even selling. I'm just going to sit it out. Now, as far as the S&P 500 is concerned, do we see the same story here? So as far as the S&P is concerned, let me see. I think I have to recall my chart here. Okay, on a monthly time frame, the S&P 500 looks very bullish, although there was no all-time high. There was at a 10, but not quite, okay? The high traded on Friday was 6,924.29. It is marginally lower than the all-time high at 6,924.99, okay? So it is just a hair breadth away from taking out the all-time high, but it did not. So the momentum suggests that there is still upward pressure in favor of further gains ahead. And based on the monthly time frame, there's a possibility the market will go up to 9,000 points, okay, which is at least 2,000 points away from where we are right now. Okay, so this has momentum because of the various reasons that I cited: year-end, window dressing, and possibility of chaos coming in from the Bank of Japan when they hike interest rates. Okay, so those are the key consideration, and I think sensible investors may actually want to book their profit if they have. Okay, and rather than commit to new positions. So we'll look into the let me see, I'll look into the weekly time frame. Weekly time frame here is again getting very, very close to the all-time high, no sign, but we have a very minor counter trend in place. And if that's the case, there is a possibility we can see an ABC move to retest the 6,508 low that we saw just last month. Okay, so going forward, if the market continue to take out the high here at 6,924.99, the projected target is at 8,240 there. Okay, so it is strong, but I won't be looking to buy. So this is the daily time frame. We have what appears to be a completed three wave. Market rallied, failed to take out the all-time high. It may still continue to try the all-time high in the new week. Okay, if it does fail, then there's a possibility it will come back and retest the 6,508 and come a larger three-wave pullback. All right, so this is the outlook even for the medium term. So nothing to see here, in my opinion, unless you are very gung-ho and want to chase the market ever higher. Now, in the NASDAQ 100, we will notice that the NASDAQ itself is getting a little bit jaded. Okay, the momentum is still very strong. You can see that the entire year, Wall Street rally has been led by nothing other than tech stocks, in particularly AI companies. Okay, so this is still the case, although this week itself we have a bit of diversion where we see investors actually going back to the good old high growth stock, and that's the reason why the Dow Jones is able to create new high. Okay, so this AI bubble may actually in the background be negative for the NASDAQ 100 going forward. There will be more profit taking. So this is the weekly time frame. You can see weekly time frame managed to go up to 26,277.06 and then have a bit of a pullback. And if this end up as a corrective move, then there is that possibility based on the weakness that we saw in the market on Friday, we could be seeing a three-wave pullback. Let me see where the equality number is. Let's say I put it at 1. Okay, if it's equality move, there is a possibility market will retest the 24,000 levels. and maybe even lower at 23,400. That would be the ideal textbook example of a corrective pullback from the all-time high of 26,277, A, B, C, targeting 23,401. So that will be the classic and textbook example of a technical pullback. So again, based on the daily time frame, you can see daily time frame does look a little bit weak. Okay, the possibility of a three-wave pullback is actually quite a possibility here. Okay, it is quite possible. Okay, same thing here. Okay, so watch out for the possibility the market will go down, and if the market do break below the cloud here, this is of course the Ichimoku cloud. If it close below the cloud here, it will logically go and challenge this low here, which is the low that we saw recently. That low is at 23,834. It will likely challenge and maybe even dip below this marginally, but the target is at 23,400. Okay, so that could be one play, but do not try to sell the NASDAQ because the Dow Jones and the Russells are at record high. So they are diverging a little bit. So just because NASDAQ didn't do well this past week doesn't mean that it calls for selling. Okay, because this selling could be a result of people liquidating or closing out their long position. So they are exiting the market. What we want to see if you want to sell is evident that fresh sellers are in the market, which we are not seeing at this moment in time. Okay, we are seeing people who have been buying this rally decided it's time to cash out and pocket the profit and then go for holidays. So this could be what the motivation is. Okay, so the Russell 2000, which is a small cap index, you can see that the market, although it went to an all-time high at 2,603.6, it did not close near the high. Okay, but it is also the one of the highest closing ever recorded on the Russell 2000. By the way, the Russell 2000 is a small cap index. They are more sensitive to interest rate cuts. So if the expectation is that the Federal Reserve going forward will be looking to lower rates, it will benefit the small cap more than the other big caps. Okay, so this one could be a outright beneficiary of interest rate cuts going forward. So this daily time frame, you can see daily time frame, we have a bit of a sell-off after the market created a new high. And this is a classical outside bar. No, not really an outside bar because the low has not gone below the previous low. Okay, but it does look to be a little bit ugly because the market did a fake move. It took out the high, found the liquidity, and then turned around and closed low. So this is not a good development. It could be a manipulation going on here because for those who have been selling, obviously they'll be putting their stop near the previous all-time high. And the market creating a new high, this short position will be shaken out of position, and then the market went down. Okay, so this could, for all we know, a manipulated buying and then turning around to close week. So stock market is not where I want to be going forward. So I have no views going forward for the US equity markets. So once we look into Europe, okay, we look at the DAX, which is the German index. Do we see something similar? Not necessarily. Okay, this is the weekly time frame of the German index. Here we have 3 weeks of gain, but you can see the size of the individual candles here is not large. Okay, it's actually very compressed. So again, if you want to trade the counter trend for the brave, you can take a look at this. Okay, the possibility that this could be a three-way technical pullback is very similar to what we saw in the NASDAQ 100. Okay, all we need is just a marginal low below this most recent low, and that would have ended this simple corrective pullback. Okay, not something that I would consider as well. With daily time frame, prices are above the cloud right now, but it does look like the market is gone flat. Over the period from June to now, for 6 months, the German DAX has been trading within a very narrow band of prices, okay, between 23,000 to 24,800. So the market did not go break up in any manners, okay? So there you have it. is more likely to continue to trade sideways, in my opinion. So nothing to see in DAX. What about the FTSE, which is the UK index? Here we have the weekly time frame, which is also exhibiting a lack of momentum. In fact, it has been lacking momentum since the market pulled back from 9,939.7, okay? And that was 5 months ago. So in terms of UK equity market, it's like stuck in neutral, okay? In the daily time frame, you can see that the market has have a drop, bounce back, and this bounce does not look like it has momentum behind it. So for all we know, we could be seeing declining prices going forward in the FTSE. And if that's the case, it will also looks like there is a possibility we could see a three-wave. Now, three-wave pattern, for all you know, is a very common occurrence. Okay, if this is a three-way, there's a possibility the market will challenge this swing low here at 9,274.4. Okay, the target here is at 9,248.95. Okay, like we call it 9,250. Okay, not a lot of meat. Okay, is it worth the risk? I won't be taking a trade. Okay, that's for sure. So nothing to see in Wall Street, nothing to see in Europe. What about Asia? So, like I say, going into the BOJ interest rate decision, whatever they decide is more likely to impact the Nikkei 225. Okay, so if it does spill over and cause volatility to spike in the other equity markets, it is definitely more like a knock-on effect. Here we have the Nikkei at 52,637 and a half, 0.9. Okay, but we have that was all the way back in October. Okay, so we can see this is a weekly time frame. In late October, we can see the market traded to a new high, and for a month now, there was no attempt to trade higher. Okay, so this past 2 weeks, we can see that the market is not really motivated to go either way. Market has already priced in the possibility of a 25 basis point hike. So unless it come out very different outcome, okay, the market may just stuck here. Okay, I think going forward, more information is needed. Investors will want to know going into 2026, what is the BOJ thinking? Okay, there are some who say that BOJ may actually continue the high interest rate to 1% in the early months of 2026. So that is an expectation. If that's the case, it will be seen to be a negative for the Japanese equity markets. Okay. Daily time frame, I think nothing to see here. Again, we have a preliminary three-way pullback followed by a bounce. So if you look at it this way, there could be a larger degree three-way after completing the first set of three-way. Okay, so for all we know, we could be looking at something also like a three-way like this. Okay, that means another challenge of 48,000. Target is 46,500 thereabout. Okay. Okay, Japanese equity market also nothing to see. So it's all quiet in the equity fronts. In the Hang Seng, okay, weekly time frame is also flat. We can see that the Hang Seng went to a high for the year at 27,244, and then went sharply lower, followed by an attempt to regain control. But the bounce only went up to as high 27,177 and a half, and now it looks like it's lost momentum. Again, it does look like a possible three-way. So everything is telling us whether you're looking in the Dow Jones or not Dow Jones, you're looking into the NASDAQ, the S&P 500, or the DAX, they are all looking corrective. Okay, so if you are not somebody who wants to trade corrective move, maybe you should stay aside and just watch and let the market tell us what it wants to do. Okay, so the conclusion here is that equity market may not be the best place to be in into the last few weeks of 2026. So that being said, let's take a look at currency market. Currency market has not really been very active, okay, except for dollar Canadian. Okay, here we look at the dollar index. Dollar has been slipping since the rebound to 100.38. So this is the rebound that looks like it's been losing momentum. And this has been on the back of lower interest rate expectation. So if the Federal Reserve expect to cut more going into 2026, there is no reason to be buying the dollar other than capital flight. Okay. Now, as we go into 2026, I expect it to be very, very dark. Okay, because all the signs, as far as Europe is concerned, is gearing up for war with Russia. So in a war scenario, you can expect capital to flee Europe. And that means the euro will come under pressure and all the capital will run to the only logical place, which is New York. And if the European want to move their assets, okay, their liquid assets out of Europe because of the possible war enlargement with Russia, then they will need to take the euro to convert into US dollars, and that will work out to be demand for dollar, which will eventually find its way into US equity markets. So that could be the dynamic if you believe that a war in Europe looks like it's imminent, because all the voices that we've been hearing from the power that be in Europe, in the EU, and NATO suggest that they really, really is getting ready for war with Russia. Okay, so capital will be the first thing to flee in the prospect of a war. And based on World War One and World War Two, European capital always flow westward to the United States. Okay, so if that's going to be the scenario, get ready for dollar strength rather than dollar weakness. Okay, so that will be ironic because on one hand, we have Federal Reserve cutting interest rate, which should be seen to be negative for the dollar. But on the other hand, if there is going to be tension in the geopolitical space that may actually cause a major war in Europe, then capital is going to flee Europe to go into the United States, and that means there's demand for dollar. Okay, so both forces are contradictory depending on what is the final outcome. So if I'm you, I'm getting ready to buy dollar because the dollar index is in a major bull market. This pullback that we see in the dollar is part of a potential three wave. And if it's a three wave, yes, there could be possibility of newer low below 96.16. Okay. But the target is at 94.7, not that far away. So if the market do go down in terms of dollar index and do not sell on the breakout of 96.6 on 96.16 because we need to see momentum. So if the market just go down, take out this low, and then hit towards, let's say, 95, and if there's no follow-through selling in the dollar index, it may actually bounce. Okay? So I'm of the idea that dollar may look cheap and unloved right now. Okay, but I think there is reason to not go with the mainstream. I think I'm looking at contradictory move because the larger time frame suggests that the dominant trend in the dollar index is bullish. What we are seeing from this climb down here from 114.87 is part of a larger degree pullback. Okay, and it may not have ended just yet. Like I say, a technical pullback may actually gun for the AB equal to CD move at 94.7. Okay, so this could be something that may actually happen. So you can see even in the daily time frame, the dominant trend is down, which is in contrast to the weekly time frame, which is up. Okay, here the dominant trend suggests that we may see lower prices, and the first clue they may tell us that this decline from 110.17, which is part of a larger degree three-way pullback, okay, from 114.87, could still extend lower below 96.16. Okay. 4 hours time frame will be the first thing you will know if the market goes below 97.4. Okay, that will be telling us the medium term. Okay, meaning to say, if you look at the market from the daily perspective, this larger degree pullback may actually extend lower below 96.16. So allow the market to find its equilibrium. I'm hoping the market will go below 96.16, and I'll be very keen to see if there's any panic selling. Okay, and if the market doesn't go very much below, let's say 94.7, then there is incentive to look for buying possibilities. That will only happen in 2026, perhaps either in January or in February. Okay, so as far as the dollar is concerned, dollar currently looks weak, but inherently it is strong, okay, based on the higher time frame. So we all know that the euro is a mirror image of the dollar index. okay? Because the dollar index, the biggest component of currencies in that basket is the euro. So if the dollar index is down in a three-wave pullback, we can expect a three-wave rally in the euro, okay? So euro do have its three-wave, but unlike the dollar index, the euro three-wave bounce actually hit the target at 1.1917. The high traded was 1.1919. Okay. And now we have a bit of a bounce. You notice that I have already engaged the market on the short side. Okay. So I'm hoping to see that the momentum peters out, and then if the market goes down in a very big way, okay, in the next few, let's say in the dying weeks of 2027, that could be the cue to tell me that this could be the end of the corrective rebound from 95 cents in a euro. Okay. In the daily time frame, again, there is no momentum. Sorry, this is it. This is not the one. This is the ATR. Here we can see that the market is doing possibly. There is already a very simple 1, 2, 3 move. Okay, so the market has finished one set, and it could be possibly doing another set of three wave. This time a larger degree. And if the high at 117.63 holds, not beyond 118.20, there is hope that the market will go down. Okay, but I am prepared for the possibility the market will continue to go higher. It is a high risk trade, it's a low risk trade to me because I actually sell at quite not too bad a price, honestly. Okay, so I'm looking for that possibility here. Now, when we look into the sterling, which is the other European currency pair, do we see similar structure? Not quite, because the rebound from $1.03 all the way to $1.38, it's not classical three wave in a sense. Okay, but let's say if I have to imagine this is a very neat three wave, this will be how I'll be looking at it. So if this is the case, it does looks like on a equal leg AB equal to CD, there's possibility we may see much higher sterling rate at 148.20. But we do not know because the structure is very different. Only when the market take out this high here at 142.50, for example, do I know that it's a break of structure. Okay. For the time being, I think this swing high here may actually cap any rally attempt. Okay. But there is a possibility market will go higher to as high as 148.20. So to me, it's unclear. This is definitely part of a technical rebound. So I want to trade with the dominant trend, which is actually very bearish. You can see the bigger chart. My color box is actually pink. So the dominant trend is actually down. Okay. So all currencies relative to the dollar are enjoying its day in the sun. Okay. And I see that as part of a corrective bounce, not the main trend. So in the daily time frame, prices are inside the dominant trend box here. This is the parameter for the bullish case. Currently, prices is in the box here. It is basically sandwich where we have the counter trend trading inside the green color box. So this is not extreme condition. So here I have ABC, the market did there. Yes, actually hit target at 130, 130.77. Okay, market went on to 130.01. Okay, 130.10 actually. Okay, this is a three wave. Market is getting ready. If this is three wave, it means the market is getting ready to rally. Okay, but again, we will have to see for sure if the market take up 135, let's say 27. Nothing exciting is happening in currency market so far. But I think the one that may actually be a little bit more interesting will be the dollar versus the yen. Okay. Dollar yen has also been stuck within a band of prices. Basically, it's stuck between 140 to 162. So we have 2,200 pips range, very, very wide range. But we can see that over here, the market did attempt to come and retest the 139.60, never quite make it, bounce back. So now the market could be going up to challenge the 162. Now, the last time market challenged 162, it was met with a very aggressive intervention by the Bank of Japan and the Ministry of Finance in Japan. Okay, so now the market is getting back up to test those levels. Would the Bank of Japan come in to intervene again? Nobody knows. So again, I think to be fair, I'm going to stay away from currency as well, other on top of what I'm going to do for equity index. There is nothing worth taking a risk or taking a position into the holidays. So I won't be looking into the currencies per se, unless you want me to talk about a very specific currency pair. Let me check if you guys have any question for me. Okay, so far no question. Let's continue. If there is no request to look at other currency pairs, I will move on to precious metals. Gold has rebounded, but it did not go high enough. Okay, so we have the market recovering, okay, from the all-time high of 4,381 and 40 cents to as low as $3,886 per ounce. And now we have almost complete 100% recovery from the low. And if the high here is not registered in terms of new highs in the gold market, that is the possibility market will come back down again. Okay, so again, watch out for that possibility. Gold has been underperforming silver for quite a while now. So will that continue to be the case? We also saw a bit of a pullback, a very sharp pullback in silver on Friday. On just one day itself, it changed the look and feel of the silver market, at least in the near term. So if the market continues to go higher in the gold market, the next target could be anywhere at $5,100. Okay. Daily time frame. This will be interesting because how it closed on Friday, it is not the best looking candle bar. Okay, on the daily time frame, market did attempt to rally, but it closes on the relatively not near the high. Okay, so if that's the case, it could be suggesting a bit of exhaustion because we have a internal three-way structure here. So if the market goes lower, how do I know? I just have to do a simple support line here. And over the next few days, the market go and close below this support line here. It will mean that we will be looking at a zigzag pattern, the AB equal to CD targeting $3,860 to challenge this low. Okay, so that could be the outcome. Daily time frame, this is what we are seeing here. Let me take out this one. So in the daily time frame, we can see that gold on the 4 hours time frame has an outside bar. The market did attempt to challenge the all-time high, failed at 4,353 and 50 cents, and then closed like this. This is a very ugly looking reversal bar. Okay. So this attempt to challenge the all-time high has failed and resulted in a reversal pattern. So for all we know, Monday we may see lower prices in precious metal market. Okay. So when we compare this to silver, which is the other precious metal market, what am I getting all this? Anyway, this is the, I want to show you the weekly time frame. So weekly time frame is very, very strong. You can see that market continue to punch higher and it's very near the target. Now, I want to show you this, okay? This is a longer term rally. And I suspect it's going to unfold as a five-way. We have what looks, because this part here is the easiest to recognize. This is very, very impulsive. It fits the description of a third wave. So if this is a third wave, when we look back into the future, this one looks like wave one, wave two, especially the wave two. Wave two is struggling, it's non-impulsive. So if that's the case, this could be one, two, we are nearing three. Okay, the target is at $65.92, close enough, short of by $1 to hit the ideal target. And mind you, this is 2.618. That means it's 261 times, okay, from the first initial rally from $11.66. So this is a valid Fibonacci extension target here. So if this is the third wave, going forward, we could be seeing something a little bit more complex because the wave two was relatively simple. It means to say the fourth wave could be alternate. It could be a little bit more complex, meaning to say it's either we're going to see an ending diagonal or we're going to see a triangle or anything of those combinations. Okay, so it could be more difficult to trade the fourth wave. But if that's the case, forget about trying to sell silver. The market is still very bullish, in my opinion. If the market ever corrects, I have two positions that I have added on, and I have moved all my stops to the higher entry. If the market turn down, at most, I don't make money from the top level, the latest addition, but I will be able to protect my lower buy position. Then I will allow market to drift lower to find its equilibrium, ideally around $45.53. That because that could be potentially the fourth wave, the end of the fourth wave. Okay, and if that's the case, another new high can be expected. I need the market to stabilize, create the low here before I can actually extrapolate the next level. But based on what we can see on a higher time frame, if I take the 3.618, which is also another valid Fibonacci extension numbers, it will be pointing at $84.20 at least. So let's say we round the number to $84. Near term for this entire structure to end, we could be looking at a top here at $84 at least, provided the market book corrects and is contained somewhere around $45.50. That would be very, very ideal. So overall structure still remains very bullish with the risk that we may be seeing the start of potentially a corrective pattern back to about $45.50. Again, that is just my expectation. Here, when we look into the daily time frame, we see something very similar. This is a very ugly development. The market trade into a new all-time high in silver at $64.64, and then close Friday with a outside bar. Okay, this is also what we call the bearish engulfing bar, which is actually seriously quite negative. So if that is the start of a corrective pullback, okay, I have two options. Either I wait for the market to bounce, I exit my latest addition, hold the one at the bottom, okay, or exit both all at the same time, and then we try to reposition for the fourth wave. Okay, it all depends. Here I have a game plan. If the market wants to come down, I will look for lower levels. The moment it bounces, okay, I may do something called play safe. Exit my latest addition because this is the one that is at high risk. Although even if the market pulls back, I will break even on this trade. Just that it will be a pity to return back the money. Okay, so this is a quite ugly development. Okay, prices may bounce, and if it can bounce as high as $63.91, that would be great because this will be an area what we call, this is a flush, right? Remember, the flush is my definition of a very long bar, meaning to say that there's a lot of momentum behind this. And by looking at this, the bar before it, that is where the order block is. There must be a lot of distribution going on at this place here, anywhere between $63.91 to $64.64. So if the market continues to edge higher into this area, I may decide to close out this entry here and just wait for the possibility market will actually resume its decline. Okay, here over here in the 4 hours, we can see a bunch of prices here that may provide some kind of support. Okay, that is roughly speaking a bit of a support around this area. Okay, this entire sequence of prices here from about $56 to maybe $59. Okay, this is a flattish looking block of orders. The market has been doing the accumulation before the market breaks out. Okay, so I'm going to stay long-term bullish on precious metals for both gold and silver. But if I look at the entire structure between gold and silver, we could be looking at further gains in terms of silver outperforming gold, at least for the near term. Okay. Let me check if you have any. Oh, no, we have a new question, I believe. Ahmad is asking, can I break down the Aussie dollars pair? Of course I can, Ahmad. Okay, now before I go into crude oil, let me digress and go back in currency by looking at the Aussie. Okay, this is the Aussie market. We can see that this is a overall bearish market. The Aussie is long-term bearish. Okay, we have a bit of a rebound from 59 cents to all the way to 67 cents, and it does look like it may continue to trade a little bit higher, perhaps to challenge this immediate swing high here, this level. At any rate, the market will hit a pocket of resistance, I believe, anywhere between here to here. Okay, so if I have to mark the level, there is obviously a lot of resistance between 69 cents to 71 cent area. So if the market goes higher, expect, if you're not already bought, do not buy at current price. That's what I'm trying to say, because upside potential is not great. Okay. So if you look at the daily time frame, okay, daily time frame is favoring the long side, at least for now. Market pullback in a three wave, not quite hitting the target at 100 at 63.5 cents and started to rally. So for all we know, the market will extend higher beyond 67 cents towards this immediate swing high here at 69 cents here. All right, like I said, Ahmad, if you are not already long, this is a bad place to be buying, okay? Unless you're looking for intraday trade, okay? If I'm going to do a decision, I will stay away for currency and equity markets for the time being, at least until the new year. Huh? Any other question? Let me see. Okay, David is asking, could the long bearish bar occur in silver market on Friday due to increased margin requirement? Now, that is an old playbook. It could be, okay? Now, if you look back into the days where the Han brothers were trying to corner the market, now the Han brothers almost succeeded in cornering the silver markets, okay? And what they didn't plan for was for the exchange to change its rules. Now, we all know that we are playing with margin over here. They never factor in the fact that the exchange reserved the right to change the margin requirement. The Han brothers not only bought a lot of paper, they also bought up all the silver mines. So they thought they lock up the fiscal side of the equation, and they have been very long on silver futures. What happened was the exchange in COMEX actually institute two laws, okay, or rather two changes. Then, okay, one is to allow only selling, no buying. People can only liquidate; they cannot add new buy positions. That is one. The other one is to increase drastically the margin requirement for holding long position. And the Han brothers were caught because they have to raise money to meet the margin call. They couldn't, and they collapsed. Eventually, both brothers went bankrupt. So that was the game, that was a playbook for COMEX then. So COMEX take out the same playbook and now do the same thing? Yes. Okay. In order to stop this crazy running away of silver prices, okay, the exchange may resort to extreme measures like increasing margin call dramatically. But the situation now compared to the days of the hundreds are very different. So the buyer of precious metal markets, not only in gold, also in silver, are sovereigns. That means to say they are not people like you and me. They are not the speculators at the retail end. These are countries, central banks buying. So even if COMEX increase the margin dramatically, the central banks has many money. Okay, they have a lot of money to meet those margin calls. So I don't think it will impact the market. It will shake out the weak hands like the retail investors, but it will not move the needle even a little bit as far as central banks are concerned. They have the money, so they are not likely to exit the market. Moreover, right now, there is not enough supply of silver. Now, silver is not only a precious metal, it is also an industrial metals, okay? Solar panels need silver. A lot of industry and products do need silver. Dramatically, we also knew that silver is also needed for the production of weapon system, whether it's a radar system, whether it's a missile, they do need silver. And for many decades now, there has been no efforts to increase the supply of silver. Nobody will go and open up a mine to mine silver from silver. They will do that for gold, but they will never do it for silver, because silver comes as a byproduct when they dig for copper, for example. Okay, so nobody is going to open up a new buy just to find supplies for silver. So silver right now is definitely in shortage. We have read reports that is practically the warehouse is running on empty in London, is also running on empty in Shanghai Exchange. Now China also produce their own precious metals, but they are not selling. Okay, so that means going forward, we could see the tightness in silver market continue to result in higher prices, escalating higher prices. So here, to answer your question, in short, I don't think it's due to margin requirements. Okay. All right. I hope I have answered your question, David. Let's go on and look at the oil market. The oil, I've actually exited my oil position after holding it for a couple of weeks. In the end, I have to realize maybe the timing is a bit off. Okay, but I did not lose money on. At least I didn't do a lot. I don't lose a lot of money because I have averaged down the position. I was holding on to too long position. Then I got back in again, and that is the irony. So what happened is that as the prices of crude oil now, maybe we should start the investigation from the weekly time frame. Okay, I will remove the ATR. So we can see the prices has a bit of a spike 2 months ago. Okay, and I thought that's it, because this was an outside bar. I thought that would be the key to actually go in to buy. So subsequently, I actually managed to buy, and the initial buy didn't work out very well because market actually went back down. But what happened was that I added another position to the existing long position. But this past week, you can see prices come back now. Oh, damn. So instead of waiting to be stopped out, I say, okay, since I have no major losses, because the latest addition in the long position actually canceled out the unrealized loss at the top, and it was a break-even price. So I closed out both long position. But shortly after, when I take another look at the chart, I cannot resist going back in again to buy. Okay, because of incident happening around Venezuela. Okay, we got news that the US actually seized an oil tanker off Venezuela. So now they are showing their naked faces. They have always give us the narrative that they are, or rather, the US military is deploying assets in the Caribbean because they want to address the drug issue coming out from Venezuela. So that was the official narrative. And now the fact that they have gone in and seized an oil tanker from Venezuela, that is the basically what happened, and the mask is off. They are there for the resources. Okay. Now remember, the US produce a lot of oil on their own. In fact, they are the world oil largest exporter of oil. But you have to understand the oil produced in the United States, what we call the WTI, or the West Texas Intermediate. Those are the light sweet crude. The US refineries cannot process this grade of oil. They can only process the heavy crude, the heavy sulfur crude, which is coming in from Venezuela. So right now, with all this going on, they are not getting the oil from Venezuela. So there is a need for them to actually secure those oil from Venezuela. Only the Venezuelan oil are suitable for refinery in the United States. So what the US produce in terms of light sweet crude, they will export them all. Okay, so what they need is the heavy sulfur crude. So in this case, the possibility is that if there is going to be a situation and if it's escalate, now the latest report is that China has also moved in some military assets into Venezuela together with Russia. So if there's going to be a fight, okay, or if US actually attempts to invade Venezuela, both China and Russia will be there, okay, to actually assist the Venezuelan. So will that result in higher oil prices? I hope that is the case. Okay. Now, this is the playbook. Again, if I can survive this trade all the way into the new year, and all I need to do is wait for the situation in Europe to decay. Meaning to say, if the NATO decided to get into a hot fight with the Russian, energy prices is going to fly. Okay. In such a scenario, I do expect oil prices to easily go back above $70 per barrel, perhaps even $80. So I'm hoping that this low price is going to be a good entry for me. If I fail, I will try it again because the narrative I'm seeing happening is likely to unfold into 2026. All right, I think there are more questions being raised here. Laura is asking, what about Singapore dollars to ringgit? Unfortunately, I have no chart to show you in terms of the cross rate between the Sing dollars and the ringgit. I don't have this chart, so I don't have the answer for you. Now, TZ is asking, is it US confirmed have QE? If yes, what the QE amount? No, they are not calling it QE. Okay, remember this is called technical buying. So what it means that they have committed to inject liquidity of $40 billion per month starting in January. So it is injection of liquidity, but it's not called QE in a classical sense. So $40 billion is what the Federal Reserve have been telling us. Every single month, they will inject $40 billion into the market. Okay? So if that's the amount that you are looking for, even though the name is not QE, that is in practice, it is what it is. Okay? Right. Yeah. Jockey, thank you for the uh, heads up. Trump hinted he is about to start a land strike in Venezuela. Not so easy. Okay, not easy. If you look at the terrain in Venezuela, they cannot do a coastal assault and go straight for the capital. Maduro is hiding in the jungle in the south right now. So if they want to take the capital, okay, they will have to do a left hook from a neighboring country. Okay, it's not so easy to execute. Okay, so let's see what happens, whether Trump is good for his money. All right, let's continue. I finished crude oil. I want to go into Bitcoin. If that's okay with you, let's take a look at Bitcoin. Now, Bitcoin, let me take out this one. Bitcoin, uh, on paper, it looks a little bit bad, okay, because of this near collapse in prices. Okay, then Bitcoin prices hit a high of $126,300 and then mysteriously collapsed all the way to $80, about $80,000. That's quite a bit of a move, but it does not change the narrative in the sense that the overall directional bias is still very bullish in favor of Bitcoin. Okay, so even if Bitcoin goes down to 16,000 without taking out the 15,462, it is still part of the bull market. So it can take a lot of punishment. That is based on the monthly time frame. In the weekly time frame, okay, market looks like it may continue to slide further. Okay, because right now we have two opposing forces. On the one hand, we have the Trump White House. Okay, they have 2 feet into the crypto world, and they are talking about building Bitcoin reserve. They think that Bitcoin is going to be the answer to solve their 38,000, $38 trillion worth of debt. They are also very heavily invested in stablecoin. Now, these two developments, okay, is basically trying to shake the foundation of traditional banking. Now, remember in the States, the one that hold the purse is actually the bankers. JP Morgan is part of that cartel. Trump has said that he is going to remove, okay, the Fed chairman for not cutting interest rate fast enough. Right now, I don't think he will remove him unless he do something really, really drastic. Okay, so we just have to wait until come May, the new guys get on board, and then he will do Trump's bidding. So the Federal Reserve belongs to the banks. Federal Reserve is not part of the government structure. Okay, it's a private organization owned by the banks. So if Trump and his administration is trying to promote crypto, in particular Bitcoin and stablecoin, JP Morgan has already reacted. First, he will target the biggest Bitcoin treasuries. The Bitcoin Reserve Company, which is what I call MicroStrategy. Okay, Strategy has lost its term in terms of its share prices. At the lowest point, it was just barely 8% away from being from the value of the company lower than it's holding in Bitcoin. It will go negative. So I think if they can get MicroStrategy to dump Bitcoin, okay, or get them out of the MSCI, which is the Morgan Stanley index. If they manage to get MicroStrategy out on the index, MicroStrategy will lose the ability to tap the capital market at very favorable prices. Okay, because you need to be the index composition before people dare to invest in your debt instruments. Okay, so that being the case, if the JP Morgan managed to take out MicroStrategy, it will cause Bitcoin prices to go down lower. But we also know the other big whales, people like BlackRock, are also very, very involved in Bitcoin. So I would think, okay, the bankers want to push down the price of Bitcoin by targeting strategy, which is MicroStrategy. Hopefully that it will elicit some kind of negative reaction, and then they will go in and scoop up Bitcoin at a lower price. Because now the banks in America are allowing their client, okay, to buy cryptocurrencies, in particularly stable coins and Bitcoin, even Ethereum. Okay, so the bankers are in the game as well, but they want to be in control. So if the prices of Bitcoin continue to decay to lower levels, once we see a reaction to the upside, we must jump in because that's what I think the game is being played. Okay, they're going to shake out all the weak hands, and if the price do come back down, I think they will go in to scoop it up. Okay. So long term, based on technical outlook, I think Bitcoin is still very, very bullish. So if there's a chance to buy Bitcoin at much lower levels, so be it. It could be the last hooray for all we know to buy Bitcoin at let's say sub $100,000. Okay. So I think that will be the game plan going forward. I think that will spill over into the other altcoins. Okay, we have Ethereum here on the weekly time frame also pulling back. It hit a pocket of prices. Now, for here, there is a technical reason to believe why the market held out at 2006. Here, we have very strong rally. The clue here lies in the structure of the individual candle bar here. Now, remember, this is a weekly time frame. So one bar represents 1 week. So it was very, very impulsive. We have 1, 2, 3 continuously. And before the market took off, the area here is where I believe the area of demand is. Okay. So if the prices now come back down, incidentally, it touched the top of this area here at $2,617.65 and then bounced. So it proved to me that this area has a lot of unfulfilled buy orders. So that being the case, it may actually provide immediate support for Ethereum. Okay. So this is the daily time frame. Immediately, the market looks a little bit weak because the dominant trend in the daily time frame is down. Will we see lower prices? Perhaps. Perhaps to try to challenge this swing low over here. Okay. So there's possibility of seeing lower price nearer to $2,000 per coin in Ethereum. Let me see if there's any other question for me. No, I will continue. Okay, I think some of you are interested in Ripple, and I think Ripple has very exciting stories. Okay. Now, when I look at Ripple from the higher time frame, so this is the weekly time frame. Obviously, Ripple is still bullish. We have a very, very sharp pullback to as low as $1.39. Okay. Remember, I was long Ripple at about $2 then. Okay. But the market went up to $3 and way beyond my price, but I didn't take profit. I think it went up to as high at $3.30. Okay. I didn't take profit. But the market came down, I decided it's enough. So I exited my long position. But overall, when you look into the weekly time frame, the market has very similar structure than what we saw in Bitcoin. Very strong rally. 4 weeks in a row, the market was rallying away. And it all originated from this area. This area is 37 cents to 65 cents. So this area which I highlight in blue is going to be the area of demand. If market ever come back into this area, I will definitely be engaging the market on the wrong side. Because for me to be right, the market has a lot of potential to go way below way beyond $4. So this one has a lot of potential. So now currently I have no position in Ripple. I'm just hoping the market will go lower. Okay, whether you come or not, I do not know. But if you ever come, I would definitely be a buyer. Okay, that would be my game plan for Ripple. Okay, so here we cannot. Here there is another area of demand. Again, very similar structure, very strong rally, and it originated from this area. And this area is between $1.22 26 cents to $1.44. So by and large, whether you are looking at it from a daily time frame or working ideally in the weekly time frame, it is lower to buy for me. Okay, although I have no position right now, I'm just hoping the market will go down a lot more. Okay, so on balance, I'm not interested in equity index. I'm not interested in currencies. I am looking at precious metals and perhaps crude oil for now. Okay, because the rest, the digital assets is uh, still in development. There is no good area to get in right now. Okay, so I think I will make it my life a lot easier going into the holidays by just looking at by either silver or gold, and perhaps even oil. And that's about it. I won't be touching anything else. Anything else you want me to talk about before we end the session for today? Any last question for me? Going once, going twice. All right, guys, thank you very much for your time, and I shall see you next Sunday. In the meantime, have a great week ahead. And if you're not going to show up next Sunday, Merry Christmas to you. Bye bye.